Welcome back. Today I'm sitting down with my business partner, Bryan Wallpe. Bryan's been in the mortgage industry for over 30 years. He's seen thousands of transactions. He's closed thousands of transactions and over $1 billion in volume, probably coming up on closer to $1.5 billion in volume. He's a mortgage savant. Today we're going to talk about the changes for HOA approval, condo HOA approval from Fannie Mae and Freddie Mac that just took place. These are big changes. Bryan, give us a high-level overview of what these changes are, how they impact buyers and realtors, and what they can do to navigate this change effectively.
Great. Thanks, Shay. Thanks for having me on today. So the biggest changes are regarding what they do in terms of documenting the condominiums on a condo questionnaire. And then there's insurance, and then there's reserve requirement increases. So let me start with the condo questionnaire. So for units, 11 units or greater in the complex, again, condo complex, they are requiring full reviews. So,
how's that different from a limited review?
Yeah, the difference is really there's a little more scrutiny. There's some additional questions that are asked, and I'll explain. Yeah. So basically, Fannie Mae and Freddie Mac, who do about 80% of all mortgages in the country, or even on some of the larger loans, they follow Fannie Mae, Freddie Mac guidelines. So they influence most of the mortgages that are being done today.
And when you say influence, that just means the mortgage lenders follow their guidelines.
Exactly. So Fannie Mae and Freddie Mac buy, securitize, and then sell these in the financial markets. And so
they set the rules.
That's basically it for how to underwrite condominiums. And so really what's been happening is there's increased scrutiny on these condominiums having enough reserves, right, for improvements. And so what the trend has been, and part of this, a big chunk of this is protecting the buyer, right? As insurance costs have gone up, with general inflation on, just repairing, making repairs, getting new roofs on condominiums, things of that nature, the costs of, keeping a condo essentially compliant have gone up. And so not only that, we are in this, really low affordability types, cycle in the market, right, with higher rates. And so what Fannie Mae and Freddie Mac have done is they've recognized there's a little bit of exposure and risk. In general, HOAs want to keep the dues low, the monthly dues low, right? And so what that can do is they can delay some of the maintenance and some of the costs.
Yeah, we
on their
saw
projects.
That with the condo project in Florida that collapsed.
That Surfside.
That was worst case scenario. We don't want that to ever happen.
Yeah,
Fannie Mae and Freddie Mac don't want that to happen.
Yep.
So deeper review of the condo process. How does that affect buyers and realtors?
Yeah, I mean, the impact to the buyer is it's actually more scrutiny on the condominium process. So in some respects, it's good for the buyer to know that they're getting into a project, because really what Fannie Mae and Freddie Mac are trying to avoid is large assessments. So let's say a buyer, and the reality of it is condominiums are a little cheaper than single family homes in most markets, right? So you're going to have people buying into these condominium complexes that sometimes don't have a lot of reserves themselves. So what really it comes down to is Fannie Mae and Freddie Mac are trying to guard against these large assessments for people that are in there, which could, if you can't afford the large assessment, you could go into foreclosure. There could be all kinds of problems. It'll certainly tax you financially. What they'd rather see is like small incremental increases in the HOA dues to bolster reserves. So when there's more scrutiny on these reviews, which there will be, which there is now.
In layman's terms, what does more scrutiny mean, though? Is it just more questions about the financial standing of the HOA?
Exactly right. I mean, that's the biggest thing. They just want to make sure there's two real large things. They want to make sure they have enough reserves for future improvements to the property and general maintenance, and they want to make sure they have enough insurance on the project. We all know insurance is a big thing, nationwide, especially like in our market in Tahoe, right? HOA master insurance has gotten really expensive. So there's another thing that's happening, right? That forces HOA dues up. And some condo complexes are just doing assessments to cover because they don't know from year to year how much the insurance is going to be. So, Fannie Mae and Freddie Mac are concerned that the insurance has replacement cost coverage. So if the place burns down, they can rebuild it. And then also that there's enough in reserves, HOA budget reserves, that they're planning for future improvements and replacing roofs and things like that. So
Why is that any different from the limited review? I thought the limited review asked about that stuff too.
it does ask about, it does, it's not as comprehensive. So here's the additional questions on a full review. They ask about, have there been any inspections, for like foundational inspections, any other inspections, structural
inspections in the past
Yes.
X amount of years? Has there been
Yeah.
a reserve study in the
Yes.
past 3 years?
So here's the real thing. If they're, they look at these reserve studies now. So really, and this is a January 2027 change. They're increasing the requirement for reserves. In general terms, they're taking it from 10% to 15%, which is, a 50% increase in reserve requirements. So they realize that a lot of HOAs are underfunded for future improvements. So they're increasing the reserve requirement. So that's a really big deal starting in January. And so there are some workarounds on that, meaning if your complex is already in good standing, then as long as you're complying with the reserve study and have enough in reserves to meet future improvements, you're okay. You don't have to necessarily do the 15%. And let me explain the 15% real quickly. 15% of total HOA dues for the year is supposed to be set aside.
They
for
take
reserves.
the annual due amount
Yes.
and multiply it by 0.15.
Yes.
And then that's supposed to be set aside.
So there's two ways to qualify your condominium complex. One is just to put the 15% away. The other is to be able to prove that you're meeting the reserve requirements for the future the future improvements. Because sometimes it's not 15% of the total budget. So anyway, again, just to recap, insurance requirements are, they're looking harder at insurance on properties, and then they're also wanting higher reserves for these projects. The good news is they did away with the occupancy percent. It used to be like 50% of the occupants in that condominium complex needed to be primary residents. Owner occupied, yeah. Which is in some markets not real easy to get to.
Here in
Tahoe, they don't even have that now.
Yeah.
They still have to answer the question on, how many are occupants, second homeowners, and investors, but they don't require it to be 50% anymore. Anyway, that was actually pretty positive. So anyway, the reason this is a benefit to buyers is they just know more about what they're getting into, right? There's more transparency on, like, if a lender says this is good and the reserves are good, then that's can give more comfort to a buyer. So if I'm a real estate agent, I'm showing condominiums to my buyer, or even if I'm a listing agent.
Well, hold on, let's take a step back. This can hurt people though too, because they can also not get loans on the condos. Let's say they fall in love with a condo, and then they're not approved by Fannie Mae or Freddie Mac. The complex is not. This can hurt buyers and agents.
Yeah.
So let's talk through that.
Okay.
Why is that important? And how can people navigate that? Let's say there's a condo complex that's not approved.
Yeah. If you have a condo complex that's not approved, Fannie Mae and Freddie Mac won't, basically they won't buy that loan. However, doesn't meet their requirements. However, there's a bunch of lenders out there that do what we call in the business non-warrantable condos. So condos that don't meet the Fannie Freddie requirements. So they're out there. They're a higher rate, on average, maybe 0.5% higher rate. So you can still get in. So, and my feeling is, what's going to end up happening is these HOAs are probably going to be, the boards will probably be reactive, meaning they'll find out they're not in compliance. Some people may have to get these little slightly higher interest rate loans, and then they'll get into compliance, right? So if enough people, enough owners say, hey, we're out of compliance, we have to make some changes. And those changes are generally a little higher dues, right? Which nobody wants, but that may be the only solution to getting in compliance. Because if you're not in compliance, what can happen is it can impact values at some point, right? So if people can't get loans easily to buy one of those condos, you will see, and we've seen this in our local market, prices will come down and be reflected in that way. Or you just have to get cash buyers, and which takes away the marketability of it.
Let's say you're a buyer and you're like, hey, I want, the rate is super important. I want the lowest rate possible. I want a conventional loan, and I want to know that I can get a conventional loan on this before I start spending inspection money, appraisal money, before I get 2 weeks into the process.
Yeah.
How can people navigate that?
Well, the reality of it is they need to see the financials for the condominium, right? Like if I'm a listing agent, I'm probably getting those financials. And, we look at those documents, right, all the time.
We as lenders. For people that don't know, we're lenders in Reno-Tahoe. So.
Yeah. We as lenders, we look at those. Most lenders don't, right? Like all the big banks, they order the documents and they ship them to underwrite. Yeah, there's they're not being proactive. So we could be proactive. I mean, we are proactive. And so we can look at those first to say, is this a compliant condominium complex? So it's not super black and white all the time. It still has to get past an underwriter, but at least looking at the documents up front. And there's some pretty cool stuff out there with AI and to be able to look at the documents and find out if if there's any challenges, but so we can do that. So I'd say if I'm a listing agent, get those documents up front. It costs money to get that stuff, because you have to order it through the HOA, the property manager and such. So, but I would do that. I would make sure your condominium is compliant. You can even market it that way in the MLS, right? Like, hey, compliant condominium with Fannie Mae, Freddie Mac. I think that'll be an attractive marketing.
That is more valuable because people can get a lower rate. I mean, if you're talking 0.5% higher on a non-warrantable condo, then that's going to be a problem. One of the things I was thinking about when you talked about that, so people can get in with a non-warrantable condo loan program. Mm-hmm. The HOA can then get compliant, and then they can refinance into a warrantable regular Fannie Mae, Freddie Mac.
Correct.
Loan.
Yeah, so that is a strategy.
And lower their rate.
Now, the only exception to that is if they're underinsured, right? If you've got a complex that has 50%, is only insured to 50% of the replacement cost, that's a problem no matter what, right? Then you're
non-warrantable is not going to solve that.
Non-warrantable is not going to solve that. Even a non-warrantable lender, non-warrantable is about reserves,
right?
Like we don't have enough reserves, so the non-warrantable lenders are okay with that piece, but not insurance. They always want insurance. So every lender wants good insurance. So unless it's a portfolio lender, and there's some exceptions to that. Like if you're putting down 50% and and the lender feels like there's enough coverage, then maybe they'll go with it. So you as a buyer are still at risk if that place burns down, right? Like you're still, if they're underinsured, they're underinsured. That's coming out of your pocket. So as being a buyer, you got to be careful about buying into something like that, or just understanding the risk. So,
Bryan, I appreciate all the background here. Is there anything you'd like to wrap up with? I do want to summarize all this. But is there anything you want to add?
Yeah, just that. I think it's just being proactive. Like, if you're a real estate agent showing condos, you want to just kind of make sure it's a compliant condo, Fannie Mae, Freddie Mac approved. You can actually get your Fannie Mae, Freddie Mac approval, which is good for 3 years. The HOA has to do some work to get there. So that is an option as well. They have to do all the compliance things and go directly to Fannie Mae and Freddie Mac to get their approval. And that can last for 3 years. So that's a good thing to do. But the key is just doing the due diligence up front, because what we often see, Shay, and you know this, someone gets into their process, they're in 3 weeks, and then they find out the condo is not compliant, right? So at other lenders, and then we have to come in and try to and rescue that loan and find a lender that'll actually do it. So be proactive, get those documents as soon as possible, and yeah, that's basically it.
Or just call us if you have a buyer that needs a condo loan.
Yeah,
That works great.
yeah.
Little plug
I mean, and
there.
really, we do the upfront work on it, and other lenders just don't do that. They just wait for the documents to come in. They go right to underwriting. The underwriter says we can't do it, and they're like, "Sorry, we can't do it."
And the difference is you're out 2 weeks in your timeline, and you're out
2 to 3 weeks.
2 to 3 weeks into contract when that happens, and you've already spent thousands of dollars on inspections and an appraisal. So
Exactly.
it puts the buyer up the creek without a paddle, per
Yeah.
se. To wrap everything up, 4 reviews versus limited reviews of the past. 4 reviews are now in place on any project with 11 units or more. They look deeper into the reserve study They look deeper into the reserve study, the financials, and the insurance. And
Yeah.
they want to make sure everything looks great.
Yes.
This can be a problem with a lot of condos, so don't get tripped up on it. Be proactive. Give us a call if you've got a buyer that needs help. Bryan, thank you so much.
Great summary, Shay. You're welcome.